Yourselves there.
Put your hands up
Yes.
if you can hear us in the
Yeah,
thing.
someone has. There you go.
Someone's
Audio's
there.
Thank you.
good.
Cool.
Thank you. Had a good look at the list of who's going to join us tonight. Thank you so much. Sounds like you can hear us. And great to see lots of mutual clients, current clients, past clients, colleagues, employees. Really great to see a mix, and looking forward to giving you lots of insight as to what you might progress with your property journey this year.
Kiwis aren't usually that tied to property, you know. We kind of,
Oh, not at all.
I think it's kind of like, we just put it in the corner, forget it about it a bit.
6, 7?
Yeah, you know, sometimes
No,
it might
don't do
buy.
6,
Yeah,
7.
mate.
My son's been doing it for a year straight.
Really?
It's
Is it that? Oh gosh, is it not really?
unreasonable behaviour.
Yeah.
Unacceptable.
Unacceptable.
Yeah.
Yeah, I mean, luckily enough, I don't know what that is, so we'll
Oh,
figure-
what?
Yeah.
Okay,
Cool.
cool. Awesome. Okay, well, I'll continue into introductions in a second, but here is what you are coming to learn about and hear from us three tonight. So the current economy. Also, how is this election year 2026? The date is locked. Are you going to take action? Are you going to sit on your hands as a property owner? Tonight, you get the insight and is your opportunity to ask questions so that you can take the appropriate action for yourselves. So how will the election year, in fact, impact and put into effect changes, or what's the noise we should or shouldn't listen to coming through 2026 and beyond as a result of potential outcomes there? What do experienced investors do in election years? I bet you see patterns. You see patterns as well, Jarrod.
Oh, boy, do I see patterns. It's not what you expect.
One out of
because
three
I got asked this question. Obviously, we're going through the slides and building this out. And producer M, who was putting this together, was like, "Is it this?" I was like, "It's the complete opposite." Yeah. Traditionally, what I see anyway. Yeah.
1 out of 3 years, and it comes around so quickly. So what experienced investors do in election years, and some interesting stats or insights that we'll talk to about the lesser experienced investors as well, which is quite surprising actually. I'm here to help out some insights on the real deals, how hard you can make your next property investment work this year based on actual deals that we are seeing and turning over right this minute. And then ultimately for you to decide what is the action you're going to take this year. So we have the Economist, we have the financial advisor expert, and dare I say 20 years of investing from when I was in the womb, all coming together to help highlight the path, or at least provide you with insight and options so that you can make your decisions.
100% right. And I think because you've got three, probably slightly different angles that we're coming to this webinar with, where a lot of people are going to get value is in that Q&A section.
Yes.
And you'll see on the panel, if you scroll probably to the bottom of the screen, you'll see a Q&A function. So, make sure you're throwing in questions as we go along. We'll try and tackle them as we throughout the webinar, but sometimes we just need to wait until the end. If you put them in the chat section, we've got to scroll through and find them. So just make sure you're putting them in Q&A, not in the chat.
Perfect. Welcome. Excited to introduce first webinar we've run together.
Yeah, it
We've met a
is.
few times.
That's true,
Jarrod Kerr, so Chief Economist at Kiwibank. No stranger to Mike and James from Checks and Balances and the Lighthouse crew. I'm excited to jump in the mix and get your insights. So thank you so much for joining us. Very excited. And of course, your host from...
Dashingly handsome in that photo. I know
Look at
producer
that.
M has definitely touched that up. That's been through ChatGPT probably twice, I reckon.
That's a great smile. That's a Colgate ad
Yeah,
right
thank you.
there.
Yeah. I now won't be able to show my teeth.
The money guy.
Yeah.
Awesome. And myself, so Ilse Wolfe from Wolfe Property Coaching. Between my own and all of our clients' renovations, definitely tipped well over 500 dwellings of renovation, all about cash flow hacking, which is our trademark process to add bedrooms cosmetically to properties and multi-unit, just to really rev up gross returns, net cash flow, get the best of servicing and value add for our clients, which is 100% the strategy I love and still practice. Awesome. So let's get into the first part. You'll have a lot of questions about what's the economic, how is 2026 starting? Mike, do you want to jump in?
I think it's been a really interesting start to the year, right? Like we were talking before off camera, and you're like, look, January, absolute hissing and raw. February, kind of slowed down a bit. But for me, the really
That was the
interesting
exact opposite, I think.
was it?
I was just
Yeah.
thinking that.
Was it? Oh, I thought you said that.
Did I miss you?
Sorry,
Did-
keep running with it. No, it's a
I
good
was
story.
listening to it, and
It's a
I
good
was
story.
like, that's wild.
No,
man, 'cause
run with it, run with it. It's
February's
good.
been like
It's
quite out of
good.
control. I think the
you get
big
that from?
call for us, or from my side of the equation, which is on the lending side and giving the advice, is around like, what was the official cash rate going to do?
Yeah.
You know, when we had that inflation number come in at above 3%, we've got a new Reserve Bank governor, fairly new. You know, everyone was kind of like, what are we going to do? And we actually, I kind of was like, I think they'll raise, just because James was saying they were going to hold. But I was actually really surprised with the reaction in the swap rates out the back of it, where we saw like a 30 bip drop.
Yes.
And for everyone who's, before we jump into the jargon, a swap rate overnight, basically the price of money that banks are paying. So did you expect that? What were you sort of seeing?
Yeah, no, we did. So what happened in November was a real shambles from the Reserve Bank. They cut, and they delivered a message in such a way where the market just went, so your next move's a hike.
Yeah.
And then we saw yields lift 60, 70 basis points on a rate cut.
Yeah.
Had they delivered the message that they delivered last week, which was, it's way too early. We are very much in the early stages of this recovery. Don't worry about rate rises for a very long time.
Yeah.
And were you calling a rate hike last week?
Oh, I kind of had to. Because...
So there's two people that you need to listen to this evening.
So
Let me
tell you what it
explain
is.
why. I did, because at the last announcement, they were kind of like, the next move is going to be a hike. And then when it came in at 3
Not at the next meeting.
But when it came in at above 3 inflation,
Yeah.
I was like, well, hang on a second. They've said this, their mandate is this. Actually, the signals that they're giving out, I have to call it.
And to be fair, probably the best part of the statement last week was clarifying just that. So yes, inflation has popped to 3.1. A lot of it is what they call administered prices.
Yeah.
We all know what those are. It's your council rates, it's your
Insurances.
Insurance.
all that stuff is hit really hard. Electricity's up 30% on the year. There's a whole lot of stuff that's hurting, but it's temporary, right? It's temporary. We look through that stuff.
Yeah.
And the best bit in the statement last week was just quite simply saying inflation's going back to 2%
Yeah.
by the end of the year.
Yeah.
So that's their mandate, that's their target, and Governor Vrooman came out and said, we're going to hit it. We're going to hit it at the end of the year. So no need to jump all over a very, very fragile recovery.
Yeah, and I think what my customers are really looking for at the moment is just a bit of stability.
Yeah.
Like we've had the sugar high interest rates of 2021. We then had relatively high interest rates when you look at the debt to income ratios over the last couple of years. A lot of people have been hurting. And then they finally came back down again. And it felt like we got to the bottom of the market-ish at the end of last year, and everyone was like, great, we can take a breath. And then it just shot straight back up again.
Yeah.
Exactly, yeah.
And that's really difficult for us to give advice on, because it gets to a point where you're going, I don't know, I'm just flipping a coin here now, right? Like, yeah.
What I notice is the competitive nature of the market, even in the last few days, just the multi-offers, clients thinking they are about to submit an offer. It's a multi-offer.
Yeah.
So just that, anticipation of, okay, rates are about to head up. Sorry, just prior to this update. The rates are going to head up. I need to quickly acquire or buy. And then there was so much activity.
Yeah.
In anticipation of, okay, we actually, when you get the indicator things might head up, okay, now we know we're at the bottom. So then people try to race to purchase.
Yeah.
So didn't expect the last few days with the drop.
Well, it's interesting you say that, because that's probably the first I've heard that you're getting that sort of multi-offer activity.
Well, we're seeing it.
Yeah, that's interesting.
A lot.
We haven't heard that yet. We're hearing that there's still a lot of supply on there, and we are seeing an increase in activity from investors, which is important.
Yeah.
But they're just hitting a very soggy market. Didn't realise they were actually hitting into each other now.
Yeah,
we're,
for sure.
We're seeing it across the board, from first home buyers, owner occupiers, right through. Like for the first time in a long time, we've had people who are now, because they're like, I'll go in unconditional, I'll do the due diligence, I'll do this, I'll spend the money to make an unconditional offer, and they're now not winning. They've come in too low, even though their offer's unconditional. I don't think I've seen that for 3 years.
Wow.
You know, yeah. So there definitely is more competition in the market. I think the stock that's on the market's been a lot better.
Agree.
You know, good
Okay.
stock will always move quickly.
Yeah.
But the general, you know, quality of the stock on the market that we're seeing is it's not people offloading the dregs of the portfolio. It's not it's, and a lot of people were saying to us and other real estate agents out there who we kind of have relationships with, we're going to sell in summer. You know, we're not going to sell now. We're not going to sell last year. We're going to sell in summer. And they went out and did it. And we're seeing a lot of it move.
Yeah. I'm noticing on the investor side of things, the hardest deals to win for, I would say, investor clients looking to renovate are the standalone houses where they are competing with emotional home buyers, whether it be first home, second home. The need to acquire and secure the deal, investors are definitely getting priced out more by the owner occupiers, which is probably what you're seeing.
Yeah.
And because of those historic rates from, you know, post-COVID, those high interest rates, the pain of 22 to 2024 with the high interest rates and massively negative gearing, the learned behaviour of investors is doubling down on cash flow. So the two examples I'll show afterwards are multiple income, and I can see a massive swing of really felt pain from negative gearing last couple of years, have come down, learnt those lessons, and I won't be doing that again.
Yeah.
So, alrighty. So, this is good, we're going in deep already, but let's jump into a poll. Are you looking to purchase property this year? Your own home, investment property? Are you actively on the lookout to secure your next deal?
Usually we've got a producer doing this for us, so this is the first time we're doing it ourselves.
Alrighty. Okay, I'm launching.
Yeah. So I think this one's really like trying to gauge people's sentiment, because obviously you've got a little, quite a lot of expertise in the room on this sort of stuff. So, you know, if we kind of pitch where people are at, we can tailor the conversation to that.
Yeah. What's your intention?
And a lot of people are going, yes. Yeah.
Awesome. So we'll just let you keep
swinging back. Yeah. Jarrod, you got any big property moves this year?
No, I had a couple last year.
Yeah.
Yeah. So no, not this year. I think we'll just hold on.
Yeah.
You know, just white knuckle grip.
Yeah.
But you know, if our forecasts are right and we get 2-3% growth, it's the start of a recovery.
Yeah.
And then next year we'll get 5 to 7% on our forecast.
Yeah.
So that is a recovery.
value growth?
Okay.
Yeah. 5 to 7.
I think I dialed in 5% as my prediction for this year.
Yeah.
James went way over at 10%. I told him he was dreaming.
He goes, he mixing yield,
the eternal-
using yield
Needs
with.
a few more rate cuts. is
Yeah,
what he
he's the
needs.
eternal optimist, right? Yeah.
So but roughly 2/3, yes, looking to take action. A third, maybe gathering the info, you know, getting the insights and then assessing after that. So yeah, so 2/3 of you out there.
The real cool question off the back of this, and you can chuck this in the chat if you want, would be, why aren't you looking at taking action? So if you're not looking at buying, selling, taking some sort of action in the property market, because that's where the interesting bits start to come in, right? Because we hear a lot of people go, well, you know, there's an election on. Yeah, which I find fascinating. Maybe I haven't been through enough elections to be scarred by them. But every time I hear someone say, I'm not doing anything because of an election, I'm like, well, why not? Why wouldn't you?
Yeah. Well, it's like a third of time, right? Like 1 out of every 3 years. And like you there are things you can't control. There are things and strategies you can control and have that, and you know, you can determine outcomes, right? And choose a strategy that works for you. 3 out of 3 years.
Yeah.
A third of time, the way you put that just went,
Yeah,
oh my God.
I know.
Do we spend that much time agonising over a government?
Yeah.
Yes.
No,
yes.
I'd rather a quarter of time.
Yeah, sort of the E word comes out and then it kind of sets the tone for the year. And then it's a thematic, you know, it's sort of, oh, well, should I wait to see what happens afterwards? And like, is it that big a deal?
You know, I was hearing it at the start of last year.
Yeah.
You're kidding?
Like the start of 2025, people already had their sights on the election. As soon as National just looked like they were going to lose, and it was started last year, investors that I was talking to, no, this is going to be a change in government. And they're saying the same thing now. And it's like, wow, you guys are agonising over. And what I think it is we've got a really weak, fragile economy. I think if we were going gangbusters, if the economy was growing at like 3-4%, inflation was fine, interest rates were low, everyone was doing
down.
well, we would just roll through this this election, not that worried. But the fact that the economy is so fragile, I think people are hypersensitive to it.
Yeah, especially because a lot of investors were burnt by the interest deductibility as well.
Of course.
Yeah.
Like a lot of people quote interest deductibility to me, and I'm like, look, that was something that came in because they didn't want to do a capital gains tax, and like I actually doubt we'll ever see that again. Like I think a capital gains tax is coming. And we're kind of jumping through this without even going through it.
Yeah.
I think a capital gains tax is coming. I think it's definitely coming to property at a bare minimum.
Yeah.
And to be honest, at the moment, like that would just bring it back into line with tax on some other investments. So I'm actually not opposed to it. And I would much prefer a capital gains tax to interest deductibility again, which creates a two-tier tax system.
And this is I was going to say, and it's the thing, right? So to be taxed upon, from a buy and hold investor perspective, would you prefer to have zero of zero, be taxed 0% of zero investments you make, like make no progress, no acquisitions because of capital gains tax? In my mind is ludicrous in the sense of, well, you make a gain, it's a proportion of, but you're actually taking action. There's a benefit and there's a portion of, as opposed to zero of zero.
There's a lot of misunderstanding around it too, right? I remember, I think it was the couple of days after on the Hosking show, he said, what about your grandmother's home that she bought in the 60s for $30,000? It's now worth $3 million. Can you imagine that? No.
Yeah,
it's not on the family home for starters.
Yeah.
And it's from June 2027 onwards. So whatever property you have, you get a valuer in.
Yeah.
You say, can you value my $2 million property? And he says, yeah, sure, it's 2.1. You drop a bottle of whiskey.
Yeah.
He goes, oh, it's 2.3.
Yeah.
You go, okay,
Thanks,
so
mate.
that's my starting point. And people, I don't think, know what G stands for as well. It's
Thank you.
gain. Like you've actually got to make
made
a
a
gain
gain.
from that point on before you get taxed.
Yeah.
Now, having lived, breathed, sold a place in Sydney, we bought it in 2016, sold it last year. There was quite a meaningful capital gain on it, and I had negatively geared it right from the start because that's the sport in Australia, negative gearing. You
Shout out to
negative
the lack
gear,
of ring
man.
fencing.
Like, how much is your property negatively geared? It's a proper sport. And we had nothing to pay because of all the stuff you write off. Now, if you were going to do a capital gains tax here, I would strongly suggest not allowing so much to be written off because Australians don't actually make a lot from their capital gains tax. Where they do make a lot is their stamp duty, which is just an absolute killer.
Yeah.
And the Aussies introduced capital gains in the late 80s and just flew straight through it. Like it didn't affect their property market. The theory is you add one and then investors, want less, they want to take a chunk off the price. It doesn't necessarily happen.
And that's the thing, if you're trading or flipping property, you factor that percentage into the gain, right? The G is the gain, so you're still making the majority of that benefit, and you can factor that in along with every single dollar in your renovation and everything else.
Yeah.
If you're buying and holding, your intention is to make the gain over a longer period of time. From a servicing point of view, if you want to come see Mike and get some cash, then do the best to get your servicing going, get that gross and net yield up, right?
Yeah.
And improve your personal household situation. And over time, you've made a gain, and then a slice of that goes away. But you wouldn't, from my perspective as a buy and hold investor, would I not have 10 to 20 to 30 years of growth and net cash, positive cash flow for that? Well, that's not changing my strategy.
Yeah. I think where people also are starting to get a little bit worried again, and like one of the questions here around the RMA improving housing supply is that are we going to get the same market growth going forward that we've seen historically, right? Historically it runs 5-6% per annum. Are we going to see that going forward? And a lot of people are worried about that.
Yeah.
We kind of see buying a new build property as almost like buying the index. You're buying the S&P 500. It's just going to track the market and do what the market does. And our advice to people who are worried about that is be active in your portfolio. Look for deals. Add value. Do things that can shorten that time frame to capital gains. And again, like I think the RMA improving housing supply, I can't see that hugely impacting these types of investments because you're buying under value, spending a little bit of money and getting a lot more out of it.
What's your take on the changes with the RMA? Reducing the red tape, granny flats, minor dwellings should ease. What do you think as that rolls out, what do you think are some of the things we'll observe practically?
Well, hopefully it enables us to, produce more affordable dwellings, which is the whole point. So, running back the red tape, making it easier, more importantly, making it faster to get stuff done, I think can only be a good thing. We tend to get mixed up in the arguments where we talk about house price growth, but within that there are, more affordable dwellings potentially pulling down, averages. So what?
Yeah.
And then there is, the other parts of the market as well. But when you model the New Zealand housing market, you come up with a shortage.
Yeah.
Right? We simply allow a lot of people in here and we don't build enough roads, rails, hospitals, you name it, but also houses for them. So anything that helps increase supply. If anyone on this, on this webinar is concerned about the state of the housing market, it's all on the supply side. It is not demand. We punish investors, we blame migrants. Actually, no, it's supply.
Yeah.
If we reduce the red tape, if we enable supply to actually catch up to demand, then we wouldn't have houses being so unaffordable for many people.
So then if we're looking at the market at the moment, you go, aside from last year, I think it was like there was more stock on the market last year than in history. Do we have a supply issue? Like if there's that much stock out there, are we actually looking at it and going, is it is there really an intrinsic supply issue? Yeah,
it's a good question and one that we want to redo and have a look at for that exact reason. Yeah. So the market conditions coughed up a lot of supply, and we saw that hit the market. But where did it come from? What were they beforehand?
It's I find it from my looking back, reflecting on the last 12 years, or effectively 2025 calendar. The vacancies post-renovation, right? So our investors are buying, renovating straight off the bat. Vacancies for 3, 4, 5, 6 weeks in some regions where usually, the cleaners are forcing the builders out, the tenants are ready to move in. Yeah. And there were some macro factors of, some government supply, 3-story apartment blocks coming in. There were some macro factors that seemed to provide some supply. We also hear that we're still short of housing, but it's the first year where I had seen vacancies in between. Definitely recovering now, but sort of feels a little bit inexplicable with such a sudden shift over that period. No, didn't seem that obvious as to why.
Right.
But, yeah. Right. We probably have chatted too long.
Are we?
Producer M has just come in and been like, "Can you mute the audio and can you keep going?" And she was like, "Press the mute button." I actually don't know where the mute button is.
What were we? Are we
on the laptop? On the keyboard? Mute.
Oh, we're
has that
going through
here is that well. Better? How's that sounding?
All right.
Thumbs up.
Okay,
keep
cool.
Going.
She's like, just keep going.
Keep
cool.
going. Great. Okay. All right. So, a couple of things that I always pop up. If interest deductibility is brought back up post this election, we've talked about capital gains tax, but interest deductibility, non-deductibility.
Yeah.
Is there much hype or anticipation of that?
I don't think it'll come back in.
No.
I think it's capital gains tax in disguise. Interest deductibility.
Yeah. Well, it certainly didn't help. It was one of many factors that drove our housing market down dramatically after that COVID spike. So, it became political. The Reserve Bank obviously lifted interest rates aggressively and did things with the banks around LVRs, triple CFA, which is a swear word in banking. And then you saw this, interest deductibility being removed. Bright line test, all of it together. It's hard to say which one did the most. It all contributed to the housing market coming off quite a lot.
Yeah, I actually think one of the interesting ones here is jumping to the foreign buyer policy.
Yeah.
I see this time and time again where we're just blaming foreign buyers for stuff.
Yeah.
When we brought in the foreign buyer ban, and everyone was like, "Oh, they're buying all the houses. No one can get anything. It's all the foreigners."
And the percentage.
They ban them. and nothing happened. I was
Nothing
like,
changed,
oh,
yeah.
look at this. Like, it's actually nothing. Yeah.
You can get around it though. I've got a couple of mates who are lawyers around here and represent certain individuals.
Yeah.
They may be here on a student visa, or they may be here as a migrant, and they own 19 properties.
Really?
Yeah, and
Yeah.
it's like, okay, so who are they owning it for a syndicate or something overseas? So I remember looking into it years ago, and I think foreign ownership was as high as 8%.
Yeah.
And it's like, okay, all right. But the good research that I did see out there, it looked at New Zealand, Australia, Canada. I can't remember the other one. Might have been Singapore. Can't remember. And basically anywhere with English property rights. And there was the surge of money coming out of China and Asia.
Yeah.
And all of those markets lifted in response to it. So I wouldn't say that foreign buying has, no influence. But I mean, it's worth watching. But when you bring in extra buyers, you are bringing in extra buyers, and they're bringing in. They're not playing with New Zealand dollars. They're playing with real currency.
Stronger dollars.
Strong dollars. Yeah.
You would think that the underlying, like, let's say there wasn't a supply issue, and I agree there's a supply issue, there'd be less to speculate on. You know, like, I think fundamentally, if you fix the supply issue in the housing market, if that's what's broken, people can come in and speculate with foreign dollars, but like, unless you're BlackRock buying entire blocks going down the thing, like they're picking in a market that's ripe for speculation. The lack of tax on properties, that sort of thing, are kind of, just encourage that type of behaviour.
Well, do you know the perfect example? Christchurch. Christchurch property market is in equilibrium. They have built back beautifully, and they don't have the supply shortage that we think is elsewhere. So what have you had? Well, house prices haven't gone up as much, but they certainly haven't fallen as much, right? They're down like 7%, whereas everywhere else is down 20.
And nor did the rents. And significantly in the regions, some of far harder hit areas than Christchurch. It's a little more consistent.
Yeah.
Not short, sharp change.
So it is an example, a tangible example that we can point to of what happens when you get more supply coming onto a market. Hate to say it, 10, 11 years after an earthquake, but it just proves that point.
I think, I don't want to labour this point because Em's going to kill me if I keep talking about it. But the other thing as well is like good infrastructure. Christchurch got to redesign their city. And every time I go to Christchurch now, I'm like,
cool.
I don't want to live in Auckland. Like, please no. We're
5, 6
and
years
I
ago.
live 10 minutes from the city centre. And I'm like, Christchurch, you walk wherever you want.
Hospitality, easy to get around. 5, 6 years ago, Christchurch is undervalued. It took a while for investors to kind of listen, and now it's thriving. The planning's incredible. People are going there and showcasing it.
That's great.
Yeah. Is now a good time to buy? Okay, we sort of touched on capital gains tax. We talked about interest deductibility, non-deductibility. So from a servicing, forecasting values, any kind of overarching thoughts, Jarrod, of, as someone looking to purchase their home or property, is this a good year to buy?
Well, purchasing a home is a very personal thing, and I think when you're ready, you're ready. Don't worry about listening to anyone about, is it a good time? If you're ready, if you've got your deposit and you've made that decision to buy your forever home, go for it. Get out there, see what you can grab. In terms of timing markets, we've had a market which has gone sideways for 2, 3 years? So you haven't missed anything in the last couple of years. We're saying that house prices are going to be up 2 to 3% this year. So you're not missing a heck of a lot there either. But you're saying there's a lot of supply. So it could be a very good time actually to get out there. I think for the more seasoned investors, those that have a larger portfolio, can tend to look through the cycles best or better than most. It's always a good time to have a look around. But I think right now, with that supply being on board, I think it's a particularly good time to have a look.
There's choice, right? I think there's a lot of choice.
Where
there's good opportunity for value add or improving the property, improving the servicing. Definitely is a lot out there. Cool. Mike, do you want to talk at all on retail rates and what you're seeing as activity with your clients?
Yeah, cool. And again, this probably links back into is now a good time to buy. And like fundamentally, and probably give the disclaimer here that this is not personalised financial advice. Anything I'm talking about is just general terms.
Go out and buy.
Yeah. But now is a great time to buy. Speak to your local broker. No, it's look what we look at, and especially with our investment clients, right? And look, timing the market is a fool's game. No one can predict the future, least of all mortgage brokers. So what we're generally saying to people is like, just look at the market at the moment, right? Like, prices are back 20% from their peak. If you look at that on a graph, it looks like prices are kind of slowly going to normalize again. You've got interest rates which are now again kind of back down near the floor of probably where they'll be. And we were saying last year we kind of thought, probably March, April, maybe May would be where interest rates were at the bottom. That was more of a lucky guess than any type of prediction. And then we're seeing the stock on the market, right? And I talked about this before, where I was like, the last couple of years, there's been stock there, but you've still been having to fight over the good stock. At the moment, we're seeing quality stock in the new build space right through to the existing property space where people can add value, buy, renovate, revalue. And I think there's definitely a lot of bargains out there, but if you are looking to jump on stuff, you've got a bit of competition. And I always talk about this with first-time buyers and first-time investors. It's like, property is the slowest purchase you'll ever make right until it matters, and then all of a sudden
Hectic.
it's over in a day, right?
And spend more time buying shoes.
Honestly, and it's this crazy thing where you're like, you go through the stages. Can I afford this? I get the pre-approval. I speak to the lawyer. I speak to this bit, and then I'm like, the actual negotiation piece is usually done in a day. Right, and like you gotta, if you're not, especially if it's a good deal, you got to be on it. You got to be on it quickly. So I would say, if people are thinking, is now the right time to buy, I would say just get a good team around you, right? Like that's, get good advice, get a good team around you, because all of this is personalized advice, right? Is it a good time to buy? It's specific to the person.
With my clients, we're always looking at, overall debt level, right? So can we substantiate purchasing? Can we substantiate we have an X amount of debt on a, say, standalone freehold house, regional centre, could be Whangarei, could be Hastings, New Plymouth, wherever. The price, because of the 20% drop in value, great. Freehold asset, developable land, great lot size, add a bedroom, get the, manufacture higher returns and value. And like you say, the kind of the interest rates are towards the floor, right? So best of both in the sense of to get the cash flow, the net cash flow looking really great. If we're at the bottom of both of those things, either the total debt is about to increase by the time you lump the renovation on top, or if interest rates increase, then your net cash flow is only diminishing from that point, right? So the tricky part is grabbing the deal, cutting out the competition, because there are a lot of multi-offers, and if you dilly-dally too long, then you think you have an offer, then boom, there's someone else buying. So it's kind of, at the moment, I can see that has kicked off. And interestingly, I would say some of the investors we're seeing who have almost had a bit of pain over the last few years with cash flow are really running very detailed calculations and due diligence, which is great. But the ones who haven't been burnt as much are actually moving faster. And that's the competition, which is quite an interesting dynamic I've not seen for a while.
We say it quite a bit, right? We know quite a few people who are really intelligent and should be a lot richer than they are. And we know quite a few people who are probably not as intelligent and are much richer than they should be because they just pull the trigger.
Doing.
And I'm not saying you blindly rush into things, but there comes a point where kind of running another cash flow analysis, running another spreadsheet starts to become a hindrance, right? It's that paralysis by analysis thing. So, look, I'll acknowledge my conflict of interest. I'm a mortgage broker. I live and breathe this stuff every day. I like debt. I like property. But at the end of the day, I'm like, look, so long as people are taking action to get where they want to be, like I'm happy, right? Like I'm agnostic as to what you actually buy. What I'm concerned about is, are you making a good financial decision? And for me at the moment, I go, interest rates are down, housing supply and stock is quite good. House price forecast, if you are renovating a property to add value, doesn't really matter so much, so long as it's not going to go down 20%, in a day. So I look at the market at the moment. I go, for this style of investment, really good. And Kāinga is selling down. So there is a lot
of value add.
XKO houses out there at the moment.
There are 6 right next to us.
There are actually.
You know
I know. Yeah. big sections.
Very big
steep,
sections.
steep
Very
sections,
steep.
though.
Yeah. So
We had,
Sareb and Hillary steep.
Yeah. I do every now and then. I walk down and up James's driveway, and I'm reminded of how steep that hill is.
Oh yeah. Every Sunday night when I got to take that rubbish out, I'll tell you what.
But that's the thing, right? Again, it comes down to that stock thing. And when I say the stock is good, I don't mean the stock is pretty, right? What I mean is you're getting a good house, good bones, easy to renovate at a good price, right?
The opportunity is there.
And the XKO stuff, we're seeing a lot of people scrapping over that.
Right. Yes, I see that. And I think if I think back to about 1 year ago, just as, coming down towards the lower rates, but it was sort of that precipice of if you just hold on longer for investors who had the highly leveraged, higher negative geared properties, I think there was a point where suddenly they can't hold on anymore. And a lot of stock that was on the market we wouldn't touch because we couldn't add value. They were too cost heavy per dwelling, and the mix was wrong. But it has shifted. There's a lot more value add KO type stuff. I think we've covered this all. Actually, I think the first time investors moving. Anything you want to add to that in terms of activity?
I would say for the investors in election years, how do they act? My point at the top of the webinar was everyone expects and seasoned investors to be like, cool, I will just keep staying the course. I've got a plan. I'm going to keep going. That's actually not what I'm seeing. I'm seeing large portfolios, seasoned investors, after the interest deductibility, they've been burned and they're like, I'm hanging back, right? I'm actually going to sell some stock down to try and reduce some risk here. And to be honest, what does that mean? Well, for my customers, and not all of them are seasoned investors, it actually just means opportunity. Right? Because there are people now putting good stock on the market at reasonable prices. Because remember, these people didn't buy in 2021.
Yes.
No. Right?
That's
so
right.
they can take a reasonable price. They can meet the market. Where a lot of people, especially in the first home buyer space, a lot of people in 2020 who bought in 21 are now selling. But they can't meet the market in terms of the price, right? Our seasoned investors who are offloading some risk are actually able to meet the market, and a lot of people are snapping them up.
Are they selling to reduce overall LVR as a motivator, or and then retaining the higher cash flowing ones, or what's the trend you see with the sell down?
To be honest, from what I can see, there's actually not much trend. It's really personal to how they're feeling. Some people are really focused on the government, right? Some people are really focused. They think Labor's coming in, they're going to burn me, this. Some people are just like, hey, I got burned last time. House prices are kind of back to a reasonable level. I can shift some good stock. Time to cash out, right? I'm going on a cruise for the next 20 years and then I'll check out of this one. So it's actually like there's a ton of different reasons why people are selling. But at the end of the day, like we're just looking for opportunities for customers. And it just means there's more decent stock on the market.
Well, I think it's also worth noting that first home buyers are still really active. Like when we look at our lending to first home buyers, it's been climbing in this beautiful uptrend for 5 years. And investors normally are so much more active, but over the last couple of years, first home buyers have had more lending going to them than investors. Now that tells you two things: first home buyers are getting amongst it, and investors aren't. They've been sidelined. Just recently, like in the last 3-4 months, it has flipped, and investors have just popped back above first home buyers. So it's good to see the investors coming off the sidelines. Be interesting to see how much they do ahead of this election. But we'll have to wait and see.
So Jarrod and I have brought everyone with the economics in the market for and I know everyone's here to talk about like what are the strategies we're going to do. So I'm going to turn the questions around to Ilse for this one. Ilse, the title of this one is How to Buy to Buffer All Possibilities. And really what we're talking about when we're asking that question is like, what are some of the good deals? What are some of the factors I should be focusing on in a market that is going sideways, maybe not going up so much, maybe going down a little bit? What do you reckon?
So every investor has their, LVR/equity and deposit, right? So how strong is your balance sheet effectively? And on the other side of the coin is servicing/household income, cash flow, right? Every investor has a stronger and a weaker of the two. I'm very impatient as an investor, and over the 20 years I've been investing has been ironing out the balance of those. And whatever happens later on this year, looking to strengthen LVR, looking to strengthen or manufacture higher gross returns, and my experience and that my clients are literally executing brilliantly. There's 2 examples we want to share, South and North Island, are all about strengthening the best of both. And I honestly think, if you want to determine your outcomes, there is definitely risk in any strategy with real estate investing, but to play your own hand in determining a strengthening on both of those, so adding value in a way where you can manufacture higher cash flow, add to the value add buffers against a potential reduction, come what may. And then, purchasing, say, a 3-bedroom house, but creating a 4-bedroom rent is my backwards way of thinking we're buying at discount.
Yeah.
Basically, so how can we force appreciation on value or cash flow so that, you've pushed it as far as you can, the property, but also retain control, which is kind of getting, cake and eating it too. So ideally, reconfiguring a floor plan where you're not needing to go through a building consent process, time, red tape, lack of control, or relinquishing control to third parties. So always doing things the correct way, having your LBP, your builder tell you what's what, but in a way where you're in and out super quickly, the market hasn't changed on you mid-renovation, 4 or 5 weeks, having a post-renovation appraisal. So you can at least determine cash flows while you're in due diligence is the way that we've scaled. We're still buying, last year, this year, and our investors are winning, because the other part of being in a competitive market right now is if you can find an advantage in what you can create from that property, right? If you can turn that 2-bedroom to a 3, or that duplex, you can add bedrooms, you have a slight ability to jump up on your price against the others if they haven't spotted that opportunity as well, because you know that your cash flows are going to help you hedge that, to win. There are some awesome tactics, including literally on my way here, one of our clients who I know is logged in here as well, literally just won a duplex up in Whangarei. I'd said, please, here's a sample letter, get the, put your human aspect, say this must go alongside the sale and purchase agreement. Don't be numbers behind a piece of paper and a multi-offer. Put your human, be a human in front of that. And literally the feedback was the vendor wanted to work with you because this is them passing the baton. So just trying to find different ways to differentiate actually does have value, because you'll find, especially the vendors who have been owning these properties for decades, which are often the ones that we want to renovate, right? They feel that because that was them. So it's not just numbers. So let's jump into a second poll. Are you going to take action this year or wait? With everything you've heard just now, let's see where you're sitting. Here we go. We're about to jump into a couple, just sort of top line, give you a couple of examples, our most recent deals with what we just sort of explained, strengthening servicing income, adding value, being in and out in a few short weeks, a couple of quite different double income properties. So really leaning into creating strong cash flows for investors. I'm noticing like a double down post, last few years, high interest rates, massive negative gearing. The most common inquiry that I see is, if I can get rid of the heaviest negative cash flow asset in my portfolio, I need to replace that debt with something higher yielding. And the most popular deals, of which there are 2 different ones here, is having split income risk from the rent. So a home and income, or a mirrored duplex, or a room by room student rental. Quite a few of these examples I'm seeing really popularized off the back of some of that pain. And those are the biggest learning points. I had that probably a decade ago, and those biggest losses on cash flow are what help you kind of reconfigure and iron out, what's going to work, what's not going to work. Awesome. Okay. Oh, interesting. Impol, probably similar ratio. So 2/3 of you thinking, cool, looking to take action.
I'm really interested for people who are like, why? Like, I'm going to wait till after the election. Put it in the chat, put it in the Q&A. Tell me why you're going to wait till after the election, because, and it's just from like, maybe it's my optimistic viewpoint. I'm like, why would we wait? We're all about like controlling the things you can control. I can't control the government. I can't control the election cycle. What I can control is like, do I have a plan? Am I making the right decisions?
And would you hold back your life for a third of your life?
Yeah, when you put it like that, it is quite strange, yeah.
Too much of a control freak to allow that.
Frustrating.
Right. Cool. All right. So actually, this slide is similar to what we just discussed, where are the strengths on the deals, but what we're definitely seeing is regions are winning. You know, as an investor as well, Mike, wouldn't you agree? Like, as you're seeing, the more that, you know, you're renovating, and some of the wins, prices for property and land are obviously lower in the regional centres as opposed to key cities. Again, removing from regional centres to the satellite or servicing towns surrounding them. It's easy to commute. It's easy to have a remote job. You know, there's a real democracy around that. And so there's a massive drift outwards from the cities for cost of living. And yet the rents, dollar for dollar on the same spec, over and over again, I'm seeing as strong, if not stronger, than some of the cities. So that's how you're achieving these wicked yields. You seeing the same thing on your side?
Yeah, I think the other thing as well that's really attractive for investors in the regions is the entry price. You know, with an in-situ property, which is, you know, what we're predominantly talking about here, 30%, you know, deposit a lot of the time. You know, that's easier to attain on a dollar basis if the starting price is cheaper. So again, for a lot of people who think, look, I'm priced out because I need a 30% deposit, you know, we're seeing buys for like 400, 410, 420K in the regions, spend a bit of cash on them and you get really good uplift and yield out of them. That's not to say the regions aren't without their risks, but again, all of this is a risk-return trade-off. And again, said it before, we see buying a 2-bedroom townhouse in a city centre is just buying the index, right? We're looking to shorten some timeframes. We're looking to increase the output of the investment, and the regions are really good for that.
And I think it continues, right? It's just the nature of a growing country, right? Geographically, New Zealand's actually quite large, right? We don't have a lot of population. And it's very difficult getting around. It's very difficult. We've got a whole lot of excuses. But Auckland has been growing, right? And then people who live in Auckland long enough, their souls slowly destroyed. And you get into a car and you have a panic attack because you're thinking, this 10-minute drive could take an hour. And then you realise, well, actually, there's a new piece of infrastructure that's gone in for our points on infrastructure. Going north, and I can get to Mangawhai in an hour and a half, right? That used to be 2 hours, 2.5 on a
very windy road.
You can even go south. I don't know why you would, but you can either go south to the Tron, where I was born, and you can get down there in an hour and a half.
On a very
now,
quick
those
motorway.
two destinations that I just mentioned are just slightly outside of Auckland, but are being taken up by Aucklanders, and they have become suburbs of Auckland. And you know, you go back 20 years and you look up the coast, it's just kind of obvious, right? Of course we're going to go up the coast. You know, they used to believe Long Bay was as far as it went. No, they just kept going, and actually it goes all the way up to Kaitaia.
I grew up in Red Beach, and
there you go.
I would
Classic
speak to
example.
people, and they're like, "Oh, we used to go for holidays up there."
Yeah,
and I'm like, "Yeah," but and that's the thing, right? And so again, you know, when you're looking at Auckland, I fundamentally back New Zealand, I back Auckland, I back this country, right? I live in Auckland, and quite often I find myself thinking, I'm not sure if I'm getting the value out of this city for the premium that I'm paying. I was down in the Mount over New Year's, and I was like, I'm sorry, I can walk to the beach, and the town's right there. There's enough going on. The Bay Oval pops on a Saturday night if you want to watch some cricket. I was like, I'm just not sure. It's not London, like you're not. And I'm just not sure that Auckland offers enough to command that premium.
I don't think it does.
And that's why people are like, I can get a similar lifestyle for half the hassle and half the price down the road.
Zero cars.
I'm here for the schools.
Right?
That's why I'm here. As soon as my son's finished school,
then
I was hoping he was going to be really smart and finish early. But no, he's going to do it full time. But we're gone. We're
and again,
gone.
and it's not that I don't back the country. It's not that I don't back Auckland. I just don't think for the premium you pay, it offers enough.
What's the sort of lifestyle you're after when you get to head north or south?
What we've got up in Mangawhai, a little bit of land, a view. We're not on a fault line. We're high enough that we're not going to get swallowed up by a tsunami or some whatever. And we'll just be happy up there.
You got to come further north. I'm to Matauri Bay. That's where.
That's true. It's funny. Mangawhai is actually losing a little bit of its shine just because it's become a suburb.
The commercial industrial development just the roundabouts and things that
Bunnings,
went through the
everything.
Bunnings.
Yeah.
Like, wow, they've done their DD, right?
Yeah.
So you can see what's coming.
Yeah.
Yes.
Like you can see what
There are
they've done the work
thousands
for you.
of sections coming.
Yeah.
Well,
But still,
anyway, we're not here to talk about the 45 minutes of traffic to go through Matakana to get to Omaha Beach on the
A
weekend.
lot of people might be thinking, what's an Economist story? I
some
might
of these,
copy
some of these
paste.
people might still be in the car.
I
on the
turned
way
around
home.
and drove back. I literally, we were going to Omaha. We turned around. I was like, "No, we're going to Big Manly. I know a great spot." Yeah. Right. So we've got some examples of some properties, and again, when we're talking about these types of deals, how we structure them, what we're looking for, often people look at them and go, "That's a unicorn, right? Like that's a one-trick pony. Are you ever going to find this again?" I know we've done some stuff on some of the deals that James and I have done, and everyone's like, how do you get that again? Show me that thing. So we've just got a couple that we're going to talk about to go, hey, one's north, one's south. They do exist.
And actually just really top level, we're not going into the nuts and bolts, but just actually show you one from the South Island, one from the north. This is consistently what we're doing. Actually, we've got the road tour in Palmy, 20th of March. One of those goodies is here, but this is copy paste. These sorts of numbers and results, this is what clients are doing every day. So a couple of different ideas. This one, Dunedin, which I'm seeing, this is very much time of year specific. So the way that the Dunedin student market operates is very much on a fixed term calendar year cycle. So when you want to buy these properties, if you're looking to renovate and add significant value, actually is so it's so important that you're purchasing at the right time of year. Worst case, you purchase something that has already a tenant for the next calendar year, fixed tenancy. Obviously, you can't roll on in there and renovate. You are sitting on whatever the as-is cash flow is. So timing is absolutely key for this type of strategy. We're talking about a large two-storey house here that was oddly only 3 bedrooms, incredible views over all of Dunedin, central position on market. That is now an 8-bedroom a few weeks later. We talk about the numbers a lot, but I think what I'm always trying to educate my clients is also probing the opportunity, those qualitative factors, things like putting the person behind the sale and purchase agreement with a letter, and also understanding who the person is behind here. We had an owner who lived in this gigantic house with all these different patches of like paint tests, and they had no idea what they were doing, and they also gave up. We then discover through the lack of information, but through our research, that not only is there a house we can convert from 3 to 8 bedrooms, but there's also a minor dwelling on a different street front, and all of this is $681,000, but severely, animation. If you bought this property as it were, as a 3-bedroom house,
$680,000.
Yeah. So as it were, is about a 2.5 to 2.9% yield. Basically, rent comes in how it is, OPEX and lack of demand because of the risk of that property, how it looked. You would be topping that up at over $1,000 per month. Obviously, that's not the best outcome for an investor looking to increase their servicing and build a portfolio.
Yeah.
We want to force appreciation. We want to force the servicing. So interestingly, you can see here on these images, we've got the main house, the huge gargantuan house, got the dormer windows, and then you can see top left, there's this extra building that's actually, it has 2 street frontages. It runs from one street to another. You're like, how did I not see this? Yeah. And it actually turned out that the way it was marketed and the vendor hadn't accurately sort of presented it. So we effectively bought it below price because it turned out there are 2 dwellings, not 1. And we're going to add a bunch of bedrooms. And timing is perfect that we can pre-rent this through our awesome managers on ground, because we've done so many similar projects that they already anticipate the quality.
Yeah.
So they had we're going back to before. What's going on here? After cosmetic reno, added 5 bedrooms, about 8 weeks to full exterior repaints, maintenance. So the main house, which is nearly 300 square meters, in full interior, added 5 bedrooms. Minor dwelling, cosmetic, and full repaint on both. This is in November, December, pre-tenanted, and went from what would be $540 a week as a 3-beddy, is now $1,920 a week.
$680,000.
Wow.
275,000 for the full reno. So this is not necessarily a first-time investor, but extremely cost efficient when you think roughly $950K all in. The benefit of this type of strategy here is, the cool thing here, right? We found we could turn it into an 8-bedroom physically. but we have the ability to lock doors and take on a tenancy group of 6 or 7, depending on the demand, of which it is changing and evolving constantly. So
I mean, you can cordon off different parts of the...
Yeah, like who's your
Right.
preferred tenant group based upon credit checks, etc. In this case, we have already pre-tenanted, for this calendar year, a bunch of 7 lads, lock 1 room.
Yeah.
Because we were out of sync with the normal tenancy. So July, August is when Dunedin tenants for the following year.
Yeah.
And this was late to the party. But 180 per room times 7, and next year will be 8 because we'll hit the main cycle. Incredible.
Yeah.
But counter-cyclic to that with the minor dwelling, then we have a permanent couple or single in the minor dwelling renovated. You have the split cash flow risk. So nerding out saying, you've got this annual fixed term tenancy that rolls over, but regardless of there being vacancy here or the minor dwelling being in between, what do you want to say?
680 grand. Sorry, I'm looking at this.
This is wild, right? I know. And now every time I show a new client, they're like, I want that.
Yeah, that's the data. Yeah.
So this is a really interesting one. I think we're going to see a lot more of this. The value add, we haven't got to the point of a registered valuation post.
But I
but
can guess what it'll be.
Yeah.
I think the great thing about Dunedin is no need for healthy homes for the students.
Speak for yourself.
And no need for any furniture because they'll burn it all as well.
But exception, literally the deposit recycled from this and the high servicing, this adds to their already strong household income. They're already looking for the next. Yeah. The issue is, right, you want to do a PB, you want to do a personal best on what you've done. So what would have been negative 16,000 is literally paying them now more than 1,000 per week. So this is the cash flow we want, right? If we want to come back to Mike and go, give me some monies, that's the kind of thing we want. Now, this is one we'll be heading through. You know this. You know this one. Yeah. So we'll see this on the roadie. This is quite, I would say, what I'm noticing is massively trending. More of your typical double dwelling mirror duplex.
Was this XKO?
This is an XKO.
I was just going to say, it looks like a KO.
Yes. And then the coolest thing is, for this mutual client, it was a copy-paste of the scope and pricing because we've done exactly this deal before in the same market. So almost like dare I say, a turnkey reno. Yeah. Boom. What was really actually the opportunity here, again, being the soft sort of aspect of it, the issue for the vendor was that it was vacant, which creates opportunities for opportunists, which basically meant, it was vacant. Not all the chattels that should be there were there, which gave rise to let's renegotiate. What do you recall the purchase price on this one?
I know this property, I know this customer. I'm going to be really careful about what I say here because if you haven't given anything away, but for some customers, especially perhaps if it's their first time, you might look at a property like this and go, oh, look, it's vacant. And to Ilse's point, that creates opportunities for people to, run amok. And you might look at that and go, that's a real risk, right? And I remember having a discussion with a customer and being like, look, yep, I get it. But, these are probably just kids from the neighbourhood who have a vacant house and they're bored. So once you kind of occupy the house to that sort of thing. Again, these ones are, pretty cool.
Renegotiate down. So this is 2 bedrooms. In this case, I would almost call it, I use the word unicorn, because often when we have double income properties, separate to the Dunedin adding bedrooms on a room by room rate, that's very specific to that microcosm. Here, when we have a duplex, sometimes through cosmetic renovations with 2 dwellings, there's enough opportunity to get to a really good positive net cash flow. So we would aim for a sort of 8.5 gross return, which is annual rent divided by all the debt, which is purchase and reno. When you can cosmetically improve a property and add bedrooms, which hopefully with my animation, obviously we don't want negative gearing, that's not where I live. And when you can add bedrooms, it supercharges the outcome from the reno. If you think about perfect way to look at a property in its suburb, go to the government website, tenancy.gov.nz, look at the market rent, look at the 3-bedroom median rent. You can sort of use that as a yardstick, suburb to suburb within a market. Okay, the 3-bedroom median rent is higher in the suburb as opposed to in this, you can get your sense of relativity. There's only so far you can push a 3-bedroom rent, whether you give it a marble bench top or whatever, there's a ceiling before someone would spend that money on a 4-bedroom and upsize, right? So what I'm sort of saying here is the best return on investment for a value add strategy is when you can add a bedroom because you've actually jumped up an entire rung. You're not going from a median 3-bed to an upper quartile 3-bed, which might be $30 a week better, say.
Yeah.
You could be 170, 200 per week by then being
3
the
or
best 4-bedroom. So as a principle, that's what actually this is a bit of a unicorn, because not only did they negotiate hard, this is a duplex that was $350K. So we're not saying each side. This is 2 houses that were $350K with some wicked negotiation, and actually probably 6 weeks of it.
Yeah.
So
No, I know.
if it were easy, fine, do your 5-day CD.
Yeah.
But the ones that get you these returns take more effort.
Did you say whereabouts?
Palmerston
Palmerston
North.
North.
Palmerston North.
Yeah.
Right.
And the reval is really strong in Palmy. So the even more exciting is we're adding rooms. You can see on the left here, cosmetically, you know what, not doing anything else that requires consent. Builder comes in, prices it, scopes it within 5 or 6 weeks, as we'll walk through in a few weeks. This is two bedrooms becoming 2 3-bedrooms. And this is an owner who's in the South Island, so completely remote.
11%.
Yeah. And for that level of debt, about 200K, some obviously you saw from the before photos, remedial work, adding the bedrooms, getting some wicked rents, 11% return from an uninhabitable state to this, and without jumping on the tools, they will make a net 120 after that.
Yeah. And I think as well for this customer, it's really important, like, you know, we come back to that entry price when we're talking about the regions. You know, if you're looking like, get me, you know, a 3-bedroom, a 2-bedroom house somewhere in a major city centre, maybe with the exception of Wellington because it's not doing great at the moment. You know, like you're talking quite big numbers from a deposit standpoint, whereas, you know, 350 is actually probably pretty palatable for a lot of investors. And again, as the market's down, people's usable equity is down. So people are really focusing on where can I get the equity or the deposit to get into the market.
Yeah.
You know, probably focus on what market am I getting into, where actually I don't need so much deposit.
Absolutely, yeah. And for them, you know, actually the common situation I see is I need a cash flowing investment property to offset one that they're holding on to for whatever reason, waiting for the growth to come up, whatever. But they are tipping cash in. This project literally pays for anything else that needs that counterbalance. So incredible result, and it, like we say, completely remote, so they're not having to get on the tools either. So it's a little top line view of 2 examples that we are commonly seeing. Definitely that split cash flow duplex type deal to add value to is definitely what we're seeing trending. From our perspective, looking to increase servicing and value add, whatever happens later on in the year, giving the biggest push you can to force appreciation on both sides. That's exactly what is happening all day, every day. Particularly out in those markets in the regions.
Yeah, cool. So a couple of quick QR codes here. If you want to check in and speak to the team at Wolfe, QR code there that has their brand in the middle. If you want to chat to the team at Lighthouse, you know, we've got ours there as well. JK, if they want to catch
my QR
I was just about to say, if they want to catch up with you, where would they be able to hear maybe a bit of your commentary on a regular basis?
Well, if you want to listen to a podcast, we've got a podcast called Markets, Mystics and Mayhem, where we have a lot of fun, talk about economics, markets, everything that's going on. Otherwise, you just jump on the Kiwibank website, and there is a whole lot of really good research on there.
Yeah, and I think it's if for anyone who does listen to some of the Lighthouse content, if you ever hear go, man, Mike had a really deep cut on some economics there, I can usually assure you that the week before on the Markets Mystics Mayhem podcast, the team there might have been saying something quite similar. Yeah, and
thanks for the plug.
Yeah,
That works.
I think that was it. I'm pretty sure it was you guys talking about the Shanghai Composite Shipping Index or something, and I was I reiterate, and I said it on a podcast, and everyone was like, "You what?" And I was like, "Don't worry, guys, I know exactly what
I got it covered."
Yeah. So if you want to skip me, go straight to the source and check out
a week earlier.
The Markets Mystics Mayhem podcast. It's really good. Awesome. Cool. All right, now I think we're getting into the Q&A, are we?
We are into Q&A. So let's see if we can navigate this. Cool. Hang on. Do we have that? Oh, hang on. It's probably down. Here we go. Oh, we're already set with a bunch of questions in here. We can probably stop sharing screen. In fact,
okay.
Stop share.
I don't usually do this. I'm very nervous about I don't touch any buttons. So
Yeah, cool. Don't want to lose them.
All right.
So
okay.
I think you two are probably the experts here. I don't think anyone's going to want to talk to me about this stuff. So do you want me to pitch the questions? Yeah.
Let's see what we've
I'm
got
going to
here.
want to
actually.
hear from you two.
Oh, look, I
Yeah,
just get
yeah.
people money.
Don't put yourself down.
Cool.
Cool. Build. Okay. What are your thoughts on Simplicity's build to rent model? Actually, it's a strategy build to rent in and of itself. Thoughts on this? I mean, this is adding to
Well, I'm
supply.
actually interested in your thoughts, to be fair.
Cool. So the question is, what are your thoughts on Simplicity's build to rent model? For those of you who don't know who Simplicity are, Sam Stubbs and the KiwiSaver fund that he runs, Simplicity, are really passionate about kind of trying to use their fund to fix a lot of what they perceive to be issues of social issues or housing issues in the New Zealand economy.
You have to applaud what he's doing.
His backstory and like his purpose is so compelling and so incredible. I believe he said they're building 1,000 homes in tandem right now with zero debt. Obviously using the
Well, you
fund.
can see the ones in Mount Wellington,
Yeah.
huge, and the
Yes.
ones
Ellerslie.
yeah, massive buildings.
Yeah.
And I've heard from people saying that they're actually really well done, like from a builder's perspective.
Yeah, they are.
Apparently, you just turn up, and there's all these apartments, as you can imagine. You turn up, and there's a box, and everything you need to do in that room is in that box. You get in there, do it all, go to the next apartment,
Do the
everything's
wiring,
in the box.
Really?
So like they've come up with ways of really streamlining things and efficiencies.
That's interesting. I went to the Boeing manufacturer up in Seattle, and that's what they do. Every shift, they have a box for every shift.
Yeah.
You pick up your box, and you know exactly what you're doing.
Yeah. You
What
went to the
manufacturer? did you say?
Boeing planes.
Boeing planes. There you go.
I
Maybe
think
you got it from there.
the build to rent model, for me, anything that's trying to get people into houses, especially those who perhaps can actually afford the mortgage, but maybe the deposit is what's setting them back, I'm all for it, right? I think that, fundamentally, we know if you have a house that you own, that you live in, your quality of life is better off, your wealth is better off over time. So I applaud Sam for
And that's
what he's
not
doing.
linear.
Yeah.
In fact, it gets
exponential.
better and better and better and better and better the longer you live.
Yeah.
Yeah.
Becomes
And
more
we're,
important.
as a nation, we're behind, right? Like this is Europe, the strategy, this kind of strategy and supply has been around forever, right? Like this is
Yeah,
in
but
Europe.
we're different cultures too. Like, don't compare us to the Germans because most of them rent.
Yeah.
That's their way.
Yeah.
Our way is to actually
Ownership.
own a bit. So the Kiwi dream is that, I'm not worried about what the German dream is. I'm worried about what our dream is and how to make it affordable. So I think it can be affordable if we get enough of these simplicity type ideas about making it affordable.
Yeah.
Like, how can we use boxes to...
I do
Make it
subscribe
cheaper.
to the Spanish dream though, which is the siesta in the afternoon. Like I'm definitely here for that. Yeah.
How do you structure your holds? Oh, this will be one, Mike. How do you structure your holds as the debt to income kicks in? How do you get finance for the next property?
Cool. Especially if you're rent reliant, don't have external income. Yeah, cool. So debt to income ratio specifically applies to triple CFA lending, so retail lending.
Triple C.
Yeah, like there are
Don't talk to a banker about that.
or a mortgage broker. So there's definitely ways around it. I think you've always got to balance out what can you afford realistically and what are the risks there. Debt to income ratios are in place for a reason. But when we're looking outside of owner-occupied purchases, which are I think at like 5 or 6 times, you can go higher with investment property purchases. There are lenders out there who do not have to abide by debt to income ratio rules. Typically that's easier if it is a pure investment property, there's no owner-occupied properties in the mix, and it is owned under a non-personal entity, a trust or a look-through company. When you get to that point, this is a business transaction. Yep, interest rates are slightly higher. Yep, you're going to pay a fee to the broker or the lender or whoever. That's the cost of doing business, right? If you're getting a 10% yield, 100, 200K uplift, 300K uplift, something like that, that's probably worth it over the long run. It's just a cost of the project. Yeah. So that's how we kind of get around it. I think the only other real point on there is actually when you start to get to that point, to the second bit of your question about what if you're just relying on rental income, a lot of the times you're actually not looking at debt to income ratios that are what's restricting you. What you're actually looking at is, are you getting commercial property rates or are you getting pure residential property rates? Because a lot of banks, if you're 90% rental income, you're going to get a more commercial flavour to those interest rates. So that's probably the only other thing I'd look out for there.
Awesome. Well, thank you for that. Jarrod, in property, we've seen significant pullback in established regions. If you had to bet on any one region in New Zealand for optimal growth over the next 10 years, which region would it be and why?
You can't say Mangawai.
No. Well, depending on the time frame, right here, right now, I can't see Canterbury slowing down. I just can't. I think it's got so much momentum, and everything that we talked about with regards to infrastructure, getting the right housing mix done.
Yeah.
It's just a symphony when you go down there, and it's so much fun. I was there last week, and once again, everyone you talk to is just so much more upbeat.
Yeah, it's magic.
And you walk around here, it's just not the same. So, I'd be reluctant to ignore Christchurch at all. But I actually think Northland. I do. I think Northland.
So underrated.
You're getting further away from Auckland.
Yeah.
It is cheap.
Yeah.
And there are a lot of opportunities up there. Northland is Northland though, so you've kind of got to go up there with your eyes wide open and maybe shut at times.
Yeah.
But I think that continual crawl will happen. Yeah, Hamilton's too easy. I think it's been done. I think further north.
Yeah.
Cash flows are far stronger up there than in Hamilton.
Yeah.
Yes,
consistently.
Exactly. Yeah.
What is I find just blows my mind is, from Whangarei out to the Heads, there is so much, if you think about that kind of coastal area for Northland, it's like the further north you go, it's like Fiji, like not kidding. The beaches are incredible. You can buy beachfront land for less than $1 million. And I'm thinking, you're not behind the road, you're on the beach. It's so untapped.
Nongaroo, all the way around there. It's just fantastic. And it takes 20 minutes to drive from where you're talking to into Whangarei.
Yeah.
20 minutes.
I think
Airport's
Whangarei
right there.
is the new Palanui.
I agree.
It's
I reckon
so
Patua South. Like Patua is basically Omaha now. Patua South. My family's from Northland, so every time someone's like Whangarei or North gets a shout out, I'm inherently happy. Although I've been hearing that Whangarei is going to pop for a long time now.
True.
Sort out the Brindlewins and we can get there.
I think it's an infrastructure call. It's an infrastructure call. If they redo the rail,
had they kept that road going,
I know.
Why did they stop that road? It doesn't make sense to me.
Yeah.
The district plan is primed for amazing intensification without resource consent as well. Like we can buy medium density for don't all flock.
But hey, Northland.
Amazing. Okay, so prediction for capital gains. This might be a little bit more broad. New Zealand, 10 to 15 years. Year by year rate?
5% per year, 4 to 5% per year on average. Maybe 4% per year.
You hear a lot about speculation around it won't be how it was the last 30 years on 7% on average. Thoughts? Agree? Disagree? How do we decide?
Look, I think we'll get 5-6%. I don't see why we won't go back to those sorts of levels of growth. Maybe just a fraction below what we're used to. For me, it's what's happening underneath the hood. How do we get there? Are we supplying affordable homes and still getting those rates of return? I think it's the mix. And I don't think anyone would disagree that we need a greater supply of affordable homes. We really do if we are going to have this Kiwi dream still being a Kiwi dream.
Yeah, I think that's a really good point, right? Like if we get, it's not so much about the growth rate. If we get 5 to 6% per year growth, and that's coming from people wanting to live here, industry growing, wealth growing, unemployment being low, that's a great place to live.
That's good, yeah.
If we get 6 to 7% off speculation, that's not a great place to be in, or higher than that. So again, the underlying fundamentals probably matter a lot more than the actual top line growth rate.
Yeah, I completely agree.
Question around, I think we're not going to party specific, worst case scenario, what could investors do to plan in advance of the election?
And what could
what can they do leading up to election to strengthen, soften? So strengthen, soften any gains or blows. So I know from my point of view, if one of my clients wondering about that, it's sort of coming back to that equity versus servicing, sort of, where do you sit on the stronger side versus weaker? And if your intention is to build and acquire, where do you need to put the most work in, or what's the strategy with your next acquisition that is going to strengthen the weaker point or help you get more of an equilibrium to keep pushing forward?
Yeah.
Would be my perspective.
Worst case scenario for each party, if elected, what could you do? Again, I think you just control the factors that you can control. I think if you've been listening to the underlying theme of what we've been saying tonight is we actually can't control the election cycle. We can't control the parties that are in, to a degree. And I think you're planning on a 3-year cycle, is not something we advocate for. These are long-term assets. These are 5, 10, 20-year assets that you're holding on to, especially if you get a good one that's cash flowing positive. So for me, I go, what can you do? I would take advantage of other people's hesitation. And that would be, irrespective of the party that comes in, that would be my recommendation.
Yeah. I do have sympathy for investors here, because it does hurt when these things happen. And it's easy to sit here and say, well, just sit through it and blah, blah. No, I've got a lot of sympathy for investors who face these potential changes, which would feel radical. The investment that I mentioned in Australia before, one of the reasons we sold it is those Aussie convicts started charging us 3% tax, land tax. And, 3%, the land value of this apartment that I owned was 300 and something, and 3% on that was like 20 odd grand.
Yeah.
I thought that's most of the rent.
Yeah.
And that's an annual cash payment to effectively IRD.
Every year.
Yeah, based upon value, which is illiquid.
Yes.
But you have to find the cash every year.
And and my wife and I just went, you know what, we've hung on to it for nearly 10 years. Let's ditch it and which is probably exactly what the Australian government's trying to do.
Yeah.
Drive a few people like myself out. But those things, they can hurt, So, I do think we need to watch and worry a little bit. But what we're saying is, these things can come, we will absorb them, and the housing market will not fall 20%, right? I think we'll largely absorb it. We'll fight our way through it. We'll find our way through it and keep going. But I definitely got sympathy for those that are concerned about losing their interest deductibility.
Great question here. What is the most attractive deal throughout Ilse's career?
There's a couple of good ones.
Yeah. I'm still getting over it.
I'm talking 11% return. It's quite...
Well, of my personal portfolio, this is the issue, right? You constantly want to do a personal best on your latest, so that's the challenge. Constantly wanting to do better, and then this is the thing: as you learn over years, your criteria or buy box evolve and change. Like what I buy and expect for myself now, absolute polar opposites from, almost a hangover of the initial properties that I still have with this potential in the land, but the cash flow is awful, and they're sitting there not realizing great cash flow. So I would say for me, it's all about cash flow, because I'm always preaching this. You can't buy the groceries with capital growth, can't eat bricks.
Yeah.
So it's all about liquid cash flow, multi-units, buying right up to last year, blocks of 5, blocks of 11, where we can manufacture cosmetic value uplift and then add value in other ways where we're getting commercial leases, it kind of goes into a whole sort of more commercial area, but effectively looking at other ways to add value through the terms of the lease and just challenge to do better every time.
Yeah.
And it will be interesting, because I've seen both sides of, National versus Labor. As an investor, you win on some aspects and you do lose on some aspects when it comes to cash flow, because, different things like social housing funding are better with one versus the other. But then it's never perfect. There are pros and cons on either side, and you have to adjust and pivot. And the more you can strengthen your position to cope with that is some of the hardest lessons I've luckily been able to pivot from earlier on to absorb. So I would say cash flow, always looking for double-digit returns to help offset costs that come around, whether it be some other form of healthy homes where overnight there's a deadline and you have a bunch of houses having to add costs to it. Cash flow buffers that, and adding value to buffer any potential loss of value. Yeah.
Was that the question? I thought the
Best
question was
deal.
what
I'm not gonna
your
give-
deal of
we
your
wanted
life
a
was.
The
street
principles.
name, number.
Jeez,
we
I
wanted
feel like I'm talking to a
Grayland.
politician here.
Yeah.
Blocks of units, then.
Blocks of
Yeah.
units.
Blocks of
Okay,
units.
fine. We'll run with that.
Mike
Blocks
and
of
James
units.
is on. There you go.
Yeah, which everyone asks for now.
Yeah.
Awesome. Okay. Are you seeing big variations on valuations on properties? Very subjective area. Yeah, I guess in terms of the calculations, very subjective area, right? Two valuers are always there's going to be a margin of error, and it comes down to the inputs that come into those, particularly the larger the property scale, so going into multi-unit type territory, a few factors such as income, and then depending on the comparables that the valuer is going to reference, which can be within the city or much further spread, they've got a pretty good tolerance on that, will have a massive impact on that. Tends to be a bit of a trend with the actual cap rates that are used for those relative to where interest rates trend as well, but very subjective area.
Yeah.
You know, get a whole bunch of valuers looking at one property, 6 valuers, 6 different values.
Yeah, I think the important thing to realise is with that, I treat that kind of the valuers like we do with the negotiation. The more conversation you can have, the more you can take them on the journey, tell them what you're doing, why you're doing it, that it's not your first rodeo, you know what you're doing. Usually the stronger it is, and then you just got to be able to back it up as well.
Question, a bit out of my world with new, if you knock down an existing house and rebuild,
I can answer this one.
how does CGT, capital gains tax, work in that case?
If you knock down existing house and rebuild, I don't know. I don't build. I'm not a property developer. Yeah,
That might be a question for your accountant and council.
I would say if
probably the council.
Yeah, if you're wanting specialist advice on that, reach out to the team at Lighthouse Accounting. We specialise in property tax. We have property developers who are accountants here, so they will definitely be able to tell you all about that.
A question here about best deals from two angles: equity uplift and gross yield. Looking at price and reno.
Come on, equity uplift.
Depends what you need, but definitely when you have multiple dwellings, whether it be a duplex, like in one of these examples, or right up to 10, 12 on one title, you have this ability to have efficiency or effectively a bulk discount. Every dwelling you're purchasing on one title of land, the more you add, effectively the cost per each of those houses or dwellings reduces because fewer people can buy them. And it's kind of a bulk purchase. So then what you find is the gross returns and the cash flow benefits are kind of like on steroids because you've bought one piece of land but multiple houses, helps your cash flow. But not everyone has the budget or tolerance to go for that larger amount of debt that usually is commensurate with that.
Yeah, you got to be able to sleep at night.
Basically, yeah.
Well, yeah.
Awesome. And one more, block of flats. Okay, cool. Cool.
I was just thinking of that capital gains questions. Interesting. I would imagine if you've bought a property, say 300,000, and then you knock the property down, build something beautiful, and you spend your 700, the value of the property at that point jumps to say $1 million, and then you're sort of paying capital gains from that point on, and that 700,000 that you've spent, you just have to show that to the IRD.
That it's not a gain.
I've renovated or I've rebuilt and I've spent 700,000 and my new value is this.
Yeah.
I think they would just calculate whatever it was up until that point, and then it would jump, and then it's whatever gain it is off that point. That's my guess.
Yeah. I don't know
rational.
enough about tax, so.
Yeah,
I'm dive into it.
Where
the
there's a
accounting
will, there's a
team at
way,
Lighthouse.
right?
Yeah.
Awesome. Well, great questions. If you need to book a call, the accounting team at Lighthouse as well. Use a QR code and find Higgs on that list. But thank you so much, Jarrod. Thank you. All the effort to come in. I know your schedule is crazy busy all over the country, but massively appreciate you coming to provide insight for active investors who are now far more educated and can choose their path for the year. And Mike, for jumping in and hosting as well.
Yeah, cool. No worries.
And for expertise. So reach out. We'll send out an email to prompt you as well if there are any further questions. But your opportunity is to book in a one-on-one with either of us or Mike's team as well, depending on what you need. And then we can look at your own situation there.
Yeah, cool.
Thanks so much. Thank you.
And make sure you check out Markets, Mystics and Mayhem.
Absolutely.
Please.
Cool. Thanks, guys.
Thanks. Have a good night. Thank you.